In the short term, we are seeing eco data this week that showed increases in prices both on the consumer and the wholesale level. Do you see any sign that fears of deflation are giving way a little bit to expectations of a more sustained increase in prices?
Oh, absolutely. I think that the bounce back in prices sort of caught some people off guard. It's not to be unexpected because when you have some prices plunge as much as they did, like oil and petroleum products, it's not unusual to see, a bounce back once the economy reaches some level of stability, which it appears we have. So, I think that inflation is now back in the front of mind for most investors, and ultimately, that the resolution around inflation is going to be one of the big determinants of where we end up with bond yields.
Now, Taylor had mentioned earlier about the Treasury auctions, and of course, we are seeing a lot of supply being absorbed by the U.S. Treasury market right now with record-sized auctions of longer-dated debt. Is that messing up the market's signaling function?
Well, I think the market has to adjust for the increased supply and find rates where we can actually clear this stuff comfortably. But the other side of it, Scarlet, is that the supply function is also being heavily affected by the Federal Reserve. And the Fed has made it clear to us that they do not want to see long-term rates rise. And I would expect in the policy statements coming in September that we will see some commitment to keeping rates lower. And so I think the weakness in bonds, especially from here, would be a buying opportunity.